So welcome everyone to Tax Power Hour. Today is February 7th, 2018, and this is the February 2018 edition of Tax Power Hour. Today's episode is the S Corporation. Is it the entity of choice for 2018? We'll spend about 5 minutes talking about Tax Power Hour, generally at the webinar series, and then we'll have an open discussion with Chris, has a couple of slides, a couple of discussions we'll have about the 2018 tax reform and the difference between an S corporation and the other entity choices when it comes to mostly small business taxpayers. So Tax Power it's a webinar series that we do usually monthly. We've taken a break here and there mostly because of tax season. If you're watching this recording afterwards, you can look at the link on the screen, register for it, and you can watch it live, attend it live. And the most important piece is join the Facebook group and let's continue the discussion. Let's talk about tax, talk about your anxieties, talk about what you learn and share from each other, because this tax world is better when tax professionals and taxpayers get together and discuss what they think about the matter. So it's usually every Wednesday. We don't do, every first Wednesday of the month, we don't do a CPE on this one, and we discuss anything has to do with tax. Hopefully, at some point, I'll get some folks to sponsor this thing so I don't have to work for free. I'm trying to get the Intuit folks or some of the tax software to sponsor these things. We do get about 120, 130 people watch these things live, plus a couple hundred extra on YouTube, so that's good. About me, my name is Hector Garcia. I have a integrated tax technology kind of consulting firm in Miami. I do tax returns. I do QuickBooks work. I do business consulting. My email is hector@garciacpa.com if you want to reach out to me. And today's guest is Chris Ragain. He is a CPA. I believe he's a certified tax planner or something having to do with financial planning. I'll let Chris explain that. And he's the founder or partner of Tax Planner Pro, which is a software for accountants that downloads information from QuickBooks Online and gives you an estimation of what the taxes that you're going to pay for the year are. Not necessarily tax software, it's more tax planning software, which is pretty awesome. And also he has Halon Tax, which that's an N, not an M, so sorry about that. So Halon Tax, which is, I'll let him explain Halon Tax because I kind of still trying to understand it. And I know from this picture, he looks like a Bond villain that likes the color purple too much. But I can assure you he's not. He's one of the nicest, smartest guys I ever met. Chris, tell us real quick about what you do and your businesses.
Well, I'll tell you, I certainly hope I'm not a Bond villain, because I don't get any of the benefits of that either. So that's good. But thanks for having me, Hector. And always enjoy our time when we get to get together on these webinars, whether it be for the Power Hour or the Tax Hour. I myself am a longtime viewer of these, so I would reinforce that these are very, very helpful sessions to take out of your day. And one of the things that I don't think comes across as much sometimes is that these webinars are ways to expand your business. So most of the time we are talking about or going over concepts that you can use to grow your business, whether that be a small business if you're a small business owner here, or whether you're a tax accountant or in the tax field. I own a few businesses. I have a Ragain Financial, which is a accounting practice, kind of like Hector. My practice does bookkeeping and taxes and that kind of thing. But then Tax Planner Pro, you can find that on the Intuit App Store. It is a tax planning product, and it is going to have the new some of the new tax laws launched here in about a week and a half. And so including the Section 199A projections, which are really, really important, we're going to get into today. And then I also own Halon Tax, which is going to launch on the App Store towards the end of this year. It's kind of the next generation of tax software. It does business tax returns, but instead of the old traditional way where you're entering a lot of information yourself or maybe moving trial balances, it connects to QuickBooks Online, reads the data, and creates the tax return in about 5 seconds. And it uses a lot of logic and some artificial intelligence to do all of that, and is a very exciting kind of next generation product for tax returns. So that product is mainly for accountants. So those of you that are accountants or tax accountants or bookkeepers that are on this, it's something definitely you should check out, because it is a cool tool in your quiver, I'll say.
So quick thing, we must make a disclaimer that Chris and I are both CPAs, and we're both currently engaging on giving you some sort of tax advice. We are actually discussing our interpretation of the tax law strategies, and this is not officially tax advice, because number one, you're not paying us to do it, and number two, we're not giving you written advice about it. So this is just casual conversation, right? And also we should never give legal advice, and we don't pretend to be giving you legal advice. There are certain questions that people ask about liability on corporations and stuff like that, and we're actually not qualified to say yes, you will be liable, or not, you wouldn't be liable. We can say general concepts like people get corporations to lower the liability, but that may be the limitation in which we can talk about liability or any sort of legalities around it. So we're not giving you tax advice, we're not giving you legal advice, but you are possibly learning from our conversation and our interpretation from it. So do hire an attorney, or do hire a professional tax preparer, an enrolled agent, or a CPA, even better. If you want to get that sort of advice, and pay for it and solicit it written if you're going to use it, to your detriment per se. All right, so let's talk real quick about why people incorporate. And this is kind of like, I wanted to just kind of start very, very at the low level, because it is important to know that corporations are not there simply just to cause more work on the tax world. The real reason why most people incorporate is because they want to conduct business as an entity outside themselves. They want to build a brand outside themselves. So that's really mostly the reasons why people incorporate. Us as accounting professionals, we get the benefit that taxation becomes a bit more complicated, a little bit more difficult to interpret, and therefore we get the benefit of having to do more work, or more billable work for the client, or the client feels more inclined to hire an accountant when they have a corporation versus when they do tax returns on their own because they don't have a corporation. So that may be a sort of a positive effect to the accounting industry. The other reason why people incorporate is because they want to grow a business that can have value unto itself, hopefully something they can sell, raise capital from investors, or potentially borrow from financial institutions without them themselves being held, quote unquote, liable for that loan. Although in the real world, it really doesn't work that way, because most banks are going to force the business owners to have skin in the game and personally guarantee the loans. But I think in essence, in the spirit of incorporating most of the times is because people have that particular thought process in mind. And the third one, which is the more practical one, is to limit their personal liability. If their business makes a mistake, if one of the employees makes a mistake, if you're facing a lawsuit because one of your vehicles crashed into somebody's house or something like that, you want to be protected, that if there's a customer or another entity you're conducting business with is suing you, hopefully they sue the business and not you, and there'll be only the assets of the business will be at stake. Now, some people incorporate because they want to, quote unquote, save on taxes. And I'm putting a question mark on that, because the development of our discussion should have you decide that, because we can never give advice that says, hey, we're going to avoid taxes. Well, we can say avoid, we're going to evade taxes by incorporating. Like, that would never be a strategy. But, mechanically speaking, there are certain areas of the tax code, especially in 2018, that could benefit a small business owner to be incorporated rather than not. And in some cases, it wouldn't. The other one is to lower the chances of being audited. Again, CPAs will never, ever, ever, ever give advice based on whether something would pass scrutiny on an audit, or whether something has high chances, low chances, or that red flag that everybody talks about. Oh, I don't want to pull any red flags. I mean, every customer says, can I do this and not raise a flag? It's funny, that it's like all customers got together and they said, we're going to talk about red flags. So there's no such thing as a red flag. I mean, there are things that are blatantly wrong and blatantly obviously wrong, and there are things that obviously are illegal and unethical, and that could maybe be a red flag, but there's no such thing as an official red flag. Any tax preparer that tells you this is a red flag or this doesn't raise flags, they're either lying to you or they're extremely ignorant and they probably shouldn't be in the profession. All right, let's talk about some common myths and misconceptions. One of the misconceptions is people choose to become a sole proprietor. It's funny, in all classes that I've taken in college, they have entity choices, and sole proprietor is one of them. Nobody chooses to be a sole proprietor. Sole proprietor is the term that we use for someone that's conducting business or trader business and is not incorporated. So that's not really a choice. Every single human being in the United States that conducts in any business are quote unquote a sole proprietor until they conduct the business under a separate legal entity. Okay. So the common myths and misconceptions. Also, I covered why people don't choose to become a sole proprietor. The other one is LLCs offer more liability protection versus corporation. There's a marketing effect to LLC because it's called limited liability company. And when I ask people, why did you set up an LLC? They're like, well, I wanted a limited liability. And people don't realize that the original liability limiter entity is the corporation. And in some cases, and this is the part where I have to disclaim, this is not legal advice. In some cases, in some states, a corporation could offer even more protection than a limited liability protection. That's why I'm saying something very vague, like in some states. That way it pretty much covers my bases. LLCs and corporations do not offer the same legal benefits state by state. LLCs will fall into partnership law and corporations into corporate law. And I'll tell you what I know about this. And again, I'm not a lawyer. I'm not giving you a real long explanation, although Chris, maybe if you know a really good lawyer that can explain this really well, we could probably bring them into a different show,
All right.
a different episode. In generally speaking, in partnership law, there's almost something stipulated that if you don't have something written down, there's a default treatment for things. Where in corporate law, everything has to go by a book, by a law book, by corporate bylaws. So if you actually don't have corporate bylaws, it is possibly impossible for you to sue your ex-partner because it stole from you, because there's no bylaws that says what stealing means or not, right? You know, that sort of thing. So with partnership law, you can have nothing written down, but there could be things that stipulate who has what based on, you know, what it looks like. So it's kind of an interesting piece of it. And that's why I say you have to seek a lawyer for that. And any of my clients that incorporate or that create partnerships, the first thing I do is go to a lawyer and write down your partnership agreement, write down your corporate bylaws, because, you know, when you first incorporate and you're dreaming about how this business will be the next Fortune 500, you're in a honeymoon stage. But then when stuff gets real, you know, and you struggle, partnerships tend to struggle, and partners fight and have differences in opinion. And if you go write these things down before that and create documents around it, there will be no way to amicably end these things, or you're going to end up spending a lot of money. And the only people that get benefit at the end is the lawyers, because they're going to have to litigate this thing till forever. The
And
other
the
thing
accountants. I
is,
mean,
and the accountants, of course. Yeah, we love the corporate welfare of people not writing things down. The other thing is anyone can qualify for an S corp. That's absolutely not true. Most people know that you must be a U.S. person, and there can be more than 100 shareholders. However, you can lose your S corp status by not having something called reasonable compensation. And I'll refer you to a different webinar that Chris did, and I did, I think, also with Mariette, where we talked about reasonable compensation in more detail. But bottom line, you can't have an S corp if the officers don't pay themselves through salary, and that also has a stop on the new tax law. So we'll discuss that when Chris's turn comes in. And I'm going a little long, so I'm going to finish this up pretty quick. The other thing is, if you don't elect an S corporation when the corporation is created, you can't file as an S corporation. That's absolutely not true. You can actually go back 3 years and elect retroactively to convert an LLC to a corporation, and therefore to an S corporation, or a regular corporation to an S corp. So if you're filing for the first time, you can go back 3 years on a special provision or relief that the IRS has. The other misconception is all small businesses will get a tax break during the 2018 tax reform. That is a misconception, because we will discuss how C corps in some cases will actually get a tax hike, and in some cases could get a tax decrease, because the lower piece of the dividend bracket went up. So like more people at a higher income tax bracket can get a lower dividend tax. Right? So that's kind of like, I know it's too much mechanics for this one. Maybe we'll have another episode for that one. And also people think that single member LLCs have to file a Schedule C. Well, if you don't convert it to an S corp or to a C corp, then yes, but you don't, and you don't want to. Look, I would never recommend anyone under any circumstance to file a personal return with their business activity in it. And there's a couple of reasons for that. Number one is it'll make it impossible for you to sell your business without having to expose all your personal stuff. It'll be impossible for you to get a bank loan without having to expose all your personal stuff. In some cases, because you don't have a separate corporation, separate entity, people tend to not have the discipline to separate business and personal, so they tend to commingle more things. And there is a higher audit percentage, which we'll talk about in a second. And then double taxation is always bad. Not true. I would say 99% of times maybe, but sometimes the double taxation of C Corp, especially with the lower dividend rate for certain persons, could actually be better.
You have to thread the needle. Like you have to have the perfect situation.
Right. So there is a situation in which, there is a small group in which it will. Now, I want to show you a quick thing real quick. This is from the 2016 PDF tax stat document that the IRS published. And this is just last year. If you look at the first arrow that I'm pointing, individual tax returns that file a Schedule C, so these are sole proprietors or single member LLCs, that have between $100,000 and $200,000 in sales, which is extremely common, they get audited 2.2% of the times. And if you go in the arrow all the way in the bottom, how often are S corporations being audited? 0.3% of the time. So do I give advice to clients based on the chances of being audited? No. But is this stat significant? Yes. Okay, so draw your own conclusion on that. So if you want to see what that document looks like, it's like a 60-page document. You look at the link there below, and there's also the IRS stats directory. All the IRS stats that are made public are in that website right there. So with that said, sorry I took a little bit longer than usual, Chris, and we may go a little long. We're not restricted to 1 hour. This is not a CPE webinar, so and I know Chris can stay for a couple minutes. Let me run a polling question real quick while we do the switch. And Chris, polling questions up. Do you have any comments on what I just covered?
Well, I'll tell you that, and I think you and I talked about this like 2 years ago at QuickBooks Connect, I think, was actually talking about people who have their businesses inside their personal returns, and when they go to sell those businesses, how debilitating it can be, because the people who help you sell the business, the buyers, are really at a loss for really pulling together the information the way that they want it and understanding how the business works. And you end up having to disclose lots more information than you want. So that advice about, having a separate business tax return, I think is spot on, besides the liability pieces and besides some of the normal reasons why you're trying to separate these things out.
Just for practicality purposes. I mean, look, almost everyone starts a business small and has the dream or the idea that we're gonna be somewhere else at some point in the future. Chris, I'm passing the presenter back to you. Okay. Sure. So that the business will be something that will be funded, will go public, or I will get a partner, right? Or I'll get a loan, and all those things from a practicality standpoint are much better if we are on a completely separate tax return. So Chris, I gave you presenter so you can show your screen. I want to answer one question. Kristen is saying, quote, did you say that you will never advise a single member LLC to file in a Schedule C tax return? Question mark, question mark, question mark. So let me answer that qualified. If you don't do anything, you have to file your single member LLC in your Schedule C. If you do nothing about converting the LLC to something else or getting a partner, you have to. But I would say that whenever you have a choice, I would always set up an S corporation. I can't picture a situation where the S corporation would not be a benefit to the taxpayer. I mean, the only nuance behind it is that, yes, you're going to have to do payroll, and there'll be a little bit more administrative cost behind doing the payroll, but I would say that would be about the only nuance behind it. Chris, go ahead and
Well,
take
and
over.
2018 is the year that I'm coming out and saying that I am almost completely against naked sole proprietorships. Naked meaning no LLC, nothing limiting liability, that kind of thing. Because I have seen these become massive, massive problems later. And so many, whether you're a small business owner right now, or whether you're an accountant, you may say, well, I'm just going to start out and see how it goes. I have no idea where my business is going, so I don't want to invest in some kind of corporate structure. I can tell you that time and time again, I see this turns into a disaster if you don't do something quickly. I have a friend in Minnesota who just started a collection agency, knows me, knows what I do, and still won't start at least an LLC or a corporation. I tend to prefer the corporation, not the LLC, but won't start something to protect himself. Now, if you're in the debt collection business, this is the kind of business that can have a lot of liability with it that you don't want to have attached to your personal issues. So for me, I'm kind of and you're going to see I have a real affinity probably to the S corporation. So you're going to see that come out in some of my presentation. But can you guys see my screen now, the PowerPoint screen?
Yes, we can.
Yeah, it should say what entity is best now. And one of the pieces of the tax overhaul and the new law that was passed, while that was going on, there was these huge discussions inside the thought leadership of how tax and entity structure is done in this country, saying, well, is the C corporation going to be the preferred entity going forward? Or with this new Section 199A deduction, it doesn't make sense to be a sole proprietorship now, because you essentially don't have to, and you're going to see some of the details here in a second, but there are some nuances of this deduction that might mean that the preference is going to change. I and Hector, we were kind of going through this together some over the last few weeks, trying to find a situation where things really did become evident that some of these other entities are probably best. I don't know if we came to a conclusion, but we can show you what the data that we found, and that's kind of what the presentation is about, is what is the best entity of choice right now. Now, I want to put a caveat for me that I tend to specialize in service businesses. That could be anything from a restaurant to professional consultant, lawyers, that kind of thing. I don't do a lot of product manufacturing work. And so in some of what we're doing here, we're kind of assuming that there's no cost of goods sold and you don't have a lot of manufacturing going on, where maybe certain elements of tax law may be a little bit different. But I think for most of our examples and some of what we're going to get into, it applies to everybody. And definitely the Section 199A applies to everybody. So we'll just kind of jump into it. And Hector, if you decide you want to jump in, just jump in as usual. We kind of have that rhythm. So what I wanted to first go over is what is S corporation theory? Because what I'm going to try and get into here a little bit is, what does it mean to be in each of these entities, right? So this slide is going to kind of take you through why people try to be S corporations. And on this first one over here on the left, this is the no payroll category. So this is what everyone would like to run, but it's not legal. And legal's maybe the wrong way to put it, but it's outside the bounds of what the IRS would allow, and you could end up with an audit where they say all of your income is now payroll. So let me kind of show you what this is saying. So in the no payroll side, let me bring up my highlighter so you can kind of see my laser pointer. You guys can see my little red guy here.
And Chris, not just all the income, all the distributions as well. So
that's right, like everything you made.
Correct. I had a particular client that refused to do payroll. Like, they refused to do it. They've had this S corp for about 15 years, and they never really had payroll. Never had to per se, because never got audited. One year they happened to take out a really big loan, like a $150,000 loan, and they distributed it out. The net profit of that year was only like $30,000, And then in the audit, the auditor was so mad that for 15 years, this guy had never done payroll. He actually, the auditor took the entire distribution and make not just the net income of the business, the entire
Yeah.
distribution, and deemed that because the particular industry, their reasonable compensation documents stated that for that industry, $130,000, $125,000, I think it was a distribution, $125,000 distribution made sense as the CEO pay for that company. So it's not just the net income. In some cases, the
Yeah,
distribution can
that's a good
also be
point.
reclassified. Yeah.
And what we're really looking at here is the net income in each of these scenarios is $50,000. Here, we'll assume that this company has run zero payroll, and especially when we talk about payroll, run zero officers' compensation payroll, because there is a difference. If you're paying other employees, but then still not paying yourself, and you're making a lot of money, there's still a case to be made that you should be running officers' compensation. So assume that in this scenario, it's zero payroll, so the distributions are $50,000. That means that self-employment tax is zero, and that's because on S corporations, the distribution is not subject to self-employment tax. So the idea, the theory again, is that you can save a lot of self-employment tax if you maximize distributions and minimize payroll. In this case, you've minimized it too much, and the IRS could have a problem with it. But to illustrate the idea, let's go over to the all payroll scenario. So in all payroll, it's where you make $50,000 net income, but you run the whole thing as payroll. Now you have zero distributions, you pay the full self-employment tax on this payroll number. And this is like running a sole proprietorship or a partnership. There's no reason to be an S Corp at this point because you have not taken advantage of any of at least the self-employment tax advantages that it offers. So here, this is too extreme. So this is extreme one way, this is extreme the other way. So neither of which are probably what we would advocate. Here is kind of the middle ground where you've got net income of 50, you've got payroll maybe of 26,000, distributions of 24, and the savings versus the sole proprietorship number is 3672. So we have to understand this idea before we can kind of move into the next phase of our presentation of which entity you should be, because the S corporation, unlike any of the other entities, meaning sole prop, partnership, or C corp, has this self-employment tax savings element. So now that we've proven out what this is, we want to keep kind of going through our presentation here. So let me.
And Chris, I'll comment one thing. That middle one, if you go back for a second, that middle one that you have would be the scenario if you don't have a corporation and you have a Schedule C, would be the scenario if you are a partner in a partnership. And let's say for this example, that 50,000 is your portion of the partnership, which is like a guaranteed payment, or even a non-guaranteed payment. Either way, you're going to pay self-employment tax. You don't have the comparison with a C corporation, which I know you have another chart with. But if you had a C corporation and you would have, for example, scenario 1, no payroll, remember that a C corporation would pay taxes on the $50,000, which is 21% in 2018, plus you're going to pay a dividend tax on your personal return. The tricky thing is we don't know what the dividend tax is because it's based on your tax bracket. So certain folks pay 0, certain folks pay 15, certain folks pay 20. So that's the difficult piece of tax planning with a C corp, is that the dividend piece is the double taxation piece that we really don't know. So I just wanted to make a quick pause here, especially when people are watching this in YouTube later on and they're saying, okay, what about the C corp? What about the single member LLC? What about the partnership? That this chart encompasses everything. You just kind of have to imagine that other piece. That's, I just wanted to add that comment there.
Absolutely, and let me say something to build on what you were saying as well, Hector. The IRS has always kind of had to have kind of speak in two different ways as it relates to S corps and C corps when it comes to salary. So on an S corporation, the IRS always wants salary to be high because they're trying to collect as much self-employment tax as reasonable or possible. On a C corporation, that was always a little bit the opposite. they didn't want you running your salaries too high because that was thought of as a tax avoidance strategy of the C corporation. Well, now that the C corporation tax rates have come down, an interesting thing to watch over the next few years is, are they still trying to push for more salary, or are they okay with lower salaries still? It's a very odd thing when you've got one kind of entity where the IRS tries to say your salary should be as high as possible, and another one where they say your salary should be as low as possible, and the testing and the courts are kind of mismatched in that way. Let's take a look at this next slide. So to summarize what we're talking about here, and I want on this slide here, ignore this part. Whenever I was first putting the slides together, this was probably the way that I had interpreted it, and since then I have changed it. But the C corporations now have a 21% tax rate, a flat tax rate. That's at least our interpretation of it. It may turn out where the IRS issues guidance here over the next few months and says, no, our interpretation of the bill that was passed was that the 15% survives. But because there's some wording in it that opens the door for that kind of thing. But for now, we're going to proceed in this presentation that they say that it's a 21% flat tax, essentially, starting at $1 and moving through $18 trillion. So that's a C Corp summary. The S Corp, the new Section 199A deduction, which we're going to get into here a little bit, has a wage component to it, which is interesting because the other entities don't allow for this because the partnership has guaranteed payments, but what we understand from as far as the 199 goes, it's not going, you're not going to be able to use that to manipulate what your income is like you could with a wage in an S corporation. So that means the S corporation may have an advantage over like a partnership and a sole proprietorship. But this last piece here for sole proprietorships and partnerships, this 199A deduction could actually be more than what you get with an S corp because there's no officer wages reducing the net income that the QBI is calculated off of. So here, while the QBI and the Section 199 deduction could be more, still sole props have the self-employment tax, which kind of offsets in some cases probably the 199A deduction. So lots of complexity here. What should you take away from this, right? Well, one is the landscape has changed. I mean, and it's easy to we're getting into tax season and we're trying to get our taxes done and we're trying to stay in the 2017 tax year where not much has changed, if anything, right? I mean, maybe tax rates and some exemption numbers have changed, but as of right now, the world has changed on business tax calculations and how we go at it. You can, in many cases, no longer just pull off the top of your head, well, here's how everything goes, because that's the way it's been for the last 20 years. We now have these new calculations that have to be factored in, and you're going to need software, you're going to need education, and you're going to need practice with it so that you can issue this guidance. If you're a small business owner right now, what does this reinforce? It reinforces the value of your practitioner. And if you don't have a practitioner right now, you may find that you can really glean some value from having one, because these calculations can save you a lot of money if they're done right and thought through the right way. There's lots of planning that can go into this. I was going to move to the next slide here and start looking at calculations, Hector, unless you have anything you wanted to jump in with.
I just wanted to answer a couple of the questions here out loud. So one of the questions that people ask, and this is a common question, and this is coming from a tax preparer even possibly, but it's, do you sit down with your client and you tell them what that reasonable compensation is? So Chris, I'll let you answer your perspective. Yeah.
I do. So I have a matrix that I use that is based on a couple of things. Mostly it is based on net income. People will argue that that's not the right way to do it. I understand the argument. I have a theory which is called the independent investor framework that I use to figure out what the compensation should be. But here's really the guideline. You should be doing something instead of nothing. Because in most cases, when the IRS goes to audit or make a case out of someone when it comes to reasonable compensation, they do it because someone is grossly taking advantage of the rule. It is easy for them to prove a case when you run zero payroll. It's an easy case. You walk into tax court and you say they ran zero payroll and that's not allowed. And the court says, no problem. What do you think it should be? And you tend to side with the IRS. If you, in fact, run something that is in the modicum of reasonable, then the IRS has to prove that your compensation is unreasonable. That's a much harder case to prove. So the idea here is don't give them an easy case. That's really the advice I would give. Although I'm not giving it.
So the way to give them an easy case is by doing no compensation or doing $10,000, right? That's how you give them an easy case. The way you give them a really hard case is you pay them the equivalent of what the market value of what it would cost you to hire someone that does the work that you do, right? If you are the CEO, the top salesperson, or the top producer, and your company has maybe 2 other employees and they make $10 an hour, it's hard to make an argument that your salary is $50,000, right? So, I mean, unfortunately, there's so much judgment that has to be placed here. This is not a simple, hey, hard, fast rule, do it this way or do it that way. This is absolutely, in every way, something that is a judgment call. Now, there's a service out there called RC, Reasonable Compensation Reports. They're super expensive. I don't know how much they are, but they're like a couple $1,000
a year or something.
$400 a year. Okay, that's what it is. And it basically gives you some company does a market study of every salary, of every position, of every function on Earth or in the United States, and you can use it, and you can use that as a sort of a guidance and say, well, according to the RC reports, this is what we used. And if you do go to an audit and you use an RC report, it's going to be difficult for the IRS to prove otherwise because you were extremely diligent about that process. But if you
those are super effective, like if you have someone whose net income is $250,000 or $300,000, and you're trying to say their salary should only be like 90 grand, that's super effective because that's probably, if you look at like the BLS reports, the Labor Department statistics, they're going to say the same thing. I think that proves in court just as well as any kind of report does. But one of the things that the IRS has also said that they give credence to, if you prove your case the right way and you think about this the right way, is if I'm an orthopedic surgeon that normally would make $450,000, but I only work 10 hours a week, thus my business only makes 100 grand. My salary doesn't need to be $250,000 still. I'm only working 10 hours. So my salary on $100,000 of income probably needs to be somewhere in line with what it would be if I was full-time and making $450,000 or $500,000. So you can make arguments. The key is don't be zero. Don't be the guy that pays nothing, because I have clients that have gotten away with that for years. Honestly, they come to us and they say, well, we've never run payroll ever, and I've had this S corporation for 8 years. Does it happen? All the time. That audit rate that Hector just showed you, 0.3%. They're not looking at this stuff that crazy. But what I'm saying is, what's the point as a practitioner or as a taxpayer to tempting the tiger? There's no reason to do it. You're not saving that much money. So if you've been running zero, start out this year and say, you know what, I'm going to run something. It may not be perfect in the eyes of what I think maybe it should be or what the IRS would think, but something's better than nothing. I mean, if that's the position you're in.
So a couple other comments here, Chris, and there's some great questions and comments here. They're so relevant and they're great. One of is, if there's no profit or a very low profit, do they still have to have reasonable compensation?
So the law says yes. And this is why in situations where here's what I say: if someone is at
even with negative, even with losses,
even if it's negative, the law. Now, do I think that you would win your tax court case if you were running a loss? Absolutely. I actually don't think the IRS would bring that case.
I think distributions will come back and bite you. So if you're running at a loss, but you're also somehow getting distributions from
liabilities
or from loans, because that's really the only place where distribution could come from.
Yes.
At that point, maybe you can lose. I would kind of be I would be against what you're saying, Chris, is saying I don't think that the IRS can win a case if you're running at a loss, unless again you're taking an immense amount of
taking out those loans like you were talking about,
right.
taking out loans and taking distributions from it.
Right.
And I would also caution, as you're trying to figure out a way to practice, when somebody reaches about $10,000, $15,000 worth of net income, that's really where the S corporation can start being an option. If somebody is teetering between income and losses, you probably are best at staying in a sole proprietorship kind of position, but making sure you have limited liability protection in some way. Most businesses that I am involved with and start, we have hundreds of businesses that we serve. They are not thinking to themselves, well, I'm only going to be a $10,000 business for the next 5 years. They're thinking I'm going to be a 10 maybe this year, but I'm going to be a 40 and an 80 and 120 and a $500,000 business. So if I'm giving them advice, I'm saying, what's the right structure for the next 5 years? And the right structure for the next 5 years is a corporate entity and making sure that we have limited liability. And once they start making money, start running payroll.
Yeah, there was one last comment here, and then you can go to the next slide. One was, do you prefer to, so for high income earners, do you prefer to suggest your clients to cap Social Security as the guideline to make that compensation? So a little bit of background, Social Security is capped at about $127,000. That means that beyond $127,000, you don't pay any more Social Security tax. So that 15.3% Chris was talking about is really on the first 127,000, 128 grand. Beyond that is just Medicare, and beyond 200,000, there's still the Obamacare extra 0.9% thing, 3.9%, whatever that is. And that may, I don't know if the new tax law phases that out, but anyway, the self-employment cost is in the first 130, or the bulk of it, first $128,000. So you could be conservative by saying, oh, hey, my salary is exactly the Social Security cap. So I'm doing my patriotic duty of funding the Social Security fund, which is a humongous black box. Like, who knows what you're going to get out of it, or if you're going to get anything out of it at all. I think with a conservative Supreme Court and with a good economy and Trump being reelected and more GOP, we may even get the Social Security be completely dissolved. Who knows? It will be very unpopular, but it could happen. So we don't know what Social Security really means at the end, and most people try to avoid paying it because they really don't know what they're going to get. I prefer to put my money in the stock market or maybe in Bitcoin for that reason, because it may be as safe as the Social Security fund. Anyway, so that could be one strategy to cap out the Social Security. But then the other strategy is the one you were mentioning, that 50-50 number. Say, look, about half of my profits are going to salary. And that, so Chris, do you have a take on that?
Well, I like I said, I have a matrix that I use, and at Halon, we provide that matrix to our preparers so that they know kind of what Halon recommends, and we do some insurance with Halon, insuring your tax return. So it needs to show what the minimum compensation is. But as businesses get larger and larger and larger, you end up running into this moment where the S corporation starts to lose its viability from a self-employment tax perspective, because you're running into $400,000 and $500,000 net income kind of things. And does that mean you run $250,000 worth of payroll? That's when you really need to start turning more from the 50-50 side of things to more of the BLS side of things, and understanding what reasonable compensation is for somebody who does that kind of job. For instance, if I'm talking about an attorney, I can find lots of situations where the average attorney pay is 80 grand, and I can find it in New York or San Francisco where the average pay is 400 grand. I'm going to try and lobby that if I've got an attorney making $500,000, I'm going to try and convince them that they need to pay somewhere around $100,000 worth of payroll. And yes, they may not save as much as a percentage of their income as someone who makes $50,000, but they're still saving quite a bit compared to the alternative. What's the alternative? That they are a Schedule C, or that they're in a C corporation, or a partnership, which is kind of like a Schedule C the same way. So it's either save some money or don't. But I'm not going to advocate, hey, you're gonna make $500,000, but your salary is only gonna be 40 because I need you to save that self-employment tax. That's bad advice and bad, stewardship of the S corporation. So if that gets at the answer in any way.
Yeah, it does. There's no more questions, so you can go to the next slide if you want to.
Great.
one person is saying, Hector, as a tax preparer, aren't you liable for a person that doesn't have payroll and you file the S corp return? Look, I don't know whether I'm liable or not. One thing I could tell you is any client that doesn't do payroll, refuses to do payroll, and I do the S corp return, I give them a memo in writing saying that you must do this. The IRS, that you must do this. That you're supposed to have reasonable compensation, and if the following year they don't do it, I disengage. So I think I don't know how to interpret the liability of the tax preparer from that perspective. I think that if the first year they don't do it, it's kind of on the client. But if the second year, because it's hard, because some of these people show up in April, and for us to retroactively do payroll, and you're going to pay a whole bunch of penalties for doing payroll late, that sort of thing, that could have a repercussion. So I don't know what the right answer is, and Chris wants to comment on that. But I would say if you are a tax preparer and every single year you're condoning this behavior where they're doing an S corp without salary, I would say that at that point you're probably are doing something wrong, or maybe you're opening your own practice to a red flag because you're not doing the right thing. But I don't think I've read anything specific on that particular area. So I wanted to answer that question out loud.
Can you see my slide now, Hector?
Yes. Yep. Yeah, and we can see the titles now.
Yeah, good deal. So sorry, I just wanted this to be right because this is an important slide and one that you could even, kind of be referring to when you're trying to look at examples later on, and having the headings is good. So what this example is showing is what the total tax burden, and down here at the bottom, let me get my highlighter back on. Down here at the bottom is where the total tax amounts are, okay? And what we're trying to show is with these different setups, what someone in the exact same situation would pay in taxes given different variables. And in this first column is the sole proprietor partnership side. So in all four, we've got 150 grand worth of income. And what this is illustrating is not just the new tax rates. So the new tax rates are in here for 2018. They're in part of the calculation, but also the 199A calculation. And I can tell you that this calculation is somewhat easy so long as you're under the thresholds, which is 157.5 of taxable income for single and 315,000 of taxable income for married. Once you get over those and you start needing to calculate the reduction or the phase out, this gets really tricky, and you're going to need software help to really be able to project these. Now, here's why this is important, practitioners especially, but small business owners too. Your estimated tax payments that you are creating for clients right now could easily have them overpaying if you don't know what this new tax is going to be. And I don't think the softwares are going to be anywhere near this with their estimates until probably next fall, this time next year even. So if you're trying to do estimated tax payments and you don't want them coming in later saying, I grossly overpaid what was owed, I thought a new tax bill was signed, these kind of issues, this is why we're doing this slide, is so that you can get a feel for it really. So on the sole proprietorship side, what we have is a $150,000 business that's got business income, no wages and no payroll taxes, but we do have adjustments here, right? Because the half of the self-employment tax has to be adjusted out on the 1040. That gives up AGI of 140. The new standard deduction is $12,000 and taxable income of 128,012. Now that is under the 157, right? So they get to really enjoy either 20% of their QBI, qualified business income, or they get 20% of their taxable income. Here's where a lot of times a single sole proprietor or single business owner is always going to end up being down on that taxable income number. Because a lot of times with the standard deduction, your business income is always going to be higher than your taxable income, and thus you end up, even if you have large itemized deductions, you end up taking 20% of your taxable income as the pass-through deduction. But as we go here, here's what the 20% of the business income would be. All we're doing is 120% of 150. So this is the 199A calculation now. This is the new deduction that is available for 2018 that changes everything. So 20%, this is the test we got to run. 20% of business income is 30 grand. We don't need to worry about W-2 wage tests because we're not over the $157,000 threshold. If we were, we would need to bring in the W-2 tests. Based on 20% taxable income, the deduction can be 25,602. So what is allowed? The 25,602. So that gets lopped off of the taxable income here to where the taxable income after deduction is 102,410. Income tax, this is using the new rates. Self-employment tax, because the new tax law does not decrease the self-employment tax base. You don't get to use this deduction against your self-employment earnings. Your self-employment earnings are still at the gross Schedule C amount, essentially, or if you're a partnership, what's flowing through on the Schedule E. So your self-employment tax is here, and so your total tax is 38,844. Not to go through all of this at a huge length here, but the S corporation has a little bit different. We're assuming $75,000 worth of wages, and those wages have payroll taxes equivalent to the self-employment tax, right? So now the net business income after you subtract all of this is 63,000. Look down here. It really changes what is allowed as your 199 deduction, because this S corporation has these wages that get subtracted off of it. And that's what I was talking about in that previous slide. S corps actually don't participate nearly as much in 199 as sole proprietorships or partnerships do. But because of that, your income tax is a bit higher than what it is in the sole prop. The SE tax, however, still is a huge saver compared to what it is over here. And your net tax due is 33,081. So you can see here that there's about a $5,750 difference between S Corp and sole prop. S Corp still wins. Now, how does S Corp not win? Well, if I paid 150,000 of wages in my S corporation, I guarantee it wouldn't win anymore. It would be just like this, and it would probably be somewhat of a disaster, because at that point you're better off being a sole proprietorship. Or if I run zero payroll, we know that's wrong, but if I did, this would be much less because we're paying zero self-employment tax. This is a reasonable example here, so stick with it. It still works, means S corporation is still the right way to go. C corporation was a huge question when this is all going on. Everybody's going to want to be C corporations, right? Not right. So in the same example, $150,000, 75 of payroll, you end up paying 41,348, and that is because while you do still pay some self-employment tax because you're running wages, you also have income tax, and then you also have corporate tax. So this is assuming that you dividend everything that you had in the C corp left after it paid taxes to your personal tax return. But the taxes here, this is worse than a sole proprietorship. What if you don't run any payroll? Even worse. So you're now, see, the corporate tax is at 21%. The self-employment tax is 15.3%. So you're better off running self-employment tax and trying to get it out of here before you pay the 21% and then the dividends tax on top of it. So here, C corporation, no payroll, worst. C corporation, not a contender, at least in this kind of scenario. What the S corporation wins, and the second place goes to the sole proprietorship. Now, there are ways to manipulate the C corporation and S corporation structure to where it could work. And one of the ways, and Hector and I were talking about this earlier, one of the ways that I'm possibly might utilize it is if I have a business that does not need to dividend to me, and I would like to save that money in there for a long, long time and almost be able to pick when I pull it out. There may be some scenarios you can run that way, but if you are serving clients that make between $10,000 and $200,000, and that's your primary cohort, the S corporation in 99% of the cases is going to be the structure of choice. And that's what this is supposed to show. I think it does.
Yeah, it does. So, so a couple of things to cover here. So one of the things that I think it may come up as a misconception this year is that the QBI deduction or the Section 199A deduction is 20% of your taxable income that reduces your taxable rate, or your taxable base. When you have a partnership or a sole proprietorship, you're going to get it off the whole thing. So it may feel like getting a deduction of the entire 150,000 or 128,000 in this case that you're including here. That may feel like a better base to go from, or we say 150, it would be 150,000. So it may feel like, hey, I want to get 20% of my 150,000. That's a bigger number. When you go to S corp, you're only going to get 20% reduction of your taxable income off the portion that wasn't payroll. So you're going to get only of the net income. So it's going to feel like a much smaller deduction. And it is truly a much smaller deduction. But when you multiply that deduction times the tax bracket and then times the self-employment tax, that's where it wins. I think that possibly creates also maybe that weird sweet spot where the 20% reduction of a much bigger base, let's say 400,000, I'm just throwing a number out there, times your current tax bracket may somehow magically be a little bit less than the savings on it. But again, it's such a weird, special sweet spot where you have to run all these calculations to figure out what income bracket specifically would take the most advantage of the QBI of the section 199. In generally speaking, I would say the S corp will work. And the other piece that I like about S corps, and this has nothing to do with taxes, has to do with discipline. When companies have S corps, you force the business owners to try to live within a certain means, at least through that payroll. So they have one fixed amount of payroll they're paying, and hopefully they're tying that to their personal lifestyle. And somehow you're making a very positive impact on people's lives by, instead of treating the business as a piggy bank, they're truly separating, hey, what's business is business, what's personal is personal. And only the money that's going through payroll is the money that I have access to for my personal needs. So there's a lot of benefits beyond tax, although the spreadsheet that Chris is telling you that tax, it makes sense. But we don't always do tax just for the sake of lowering tax. Sometimes, having that discipline and the discipline to also make estimated payments, because a lot of folks don't make the estimated payments. You can give them the pay stub all day long and they just don't do it. With payroll, they're forced to. So I think it forces them to. And if you ever read Profit First, which is the concept that if you don't have the money, you won't spend it. If you're taking the money out and paying it to the government, you're less propense to spend it. So you're more propense to have taxes to pay at the end of the year. And it will be a better all-around experience, taxpayer and tax preparer, because at the end of each year, it's just a struggle with some of these clients. That's the only comment I wanted to make. Some people are commenting, why is there self-employment tax on the C Corp column? And just to answer that, that's not self-employment tax, that's the effect of payroll tax. That's what he's giving you there. So that's not self-employment tax per se, but it's the same Social Security and Medicare effect to payroll tax. Somebody else is saying, I thought payroll tax was only 7.65%. That's true, but remember, you're the owner of the business, and your corporation is paying the other 7.65%. So he's showing you that you are that's coming out of your pocket per se.
Yeah, it's kind of meant to represent net losses to the government, right? Like what you lose of your money to the government. And I would also say that as a practitioner, everyone now is going to have to start thinking through calculations that we didn't before. I can tell you this calculation gets much more significant once you get into the phase outs. So if you let me kind of jump in here real quick with
and before you do phase out, there's somebody saying, hey, what about California state tax? And one thing we haven't even mentioned is that C corporations almost always are going to pay a state corporate tax as well. We haven't even talked about the state corporate tax.
That's right.
S corporations, maybe, depending on, in Florida, S corporations don't pay any tax, but I know in some states you pay some sort of franchise quasi income tax, so most of the time C corps in addition will pay a state tax, which is another tax we haven't even considered. And depending on the state, S corps may pay no tax, or maybe some very small minimal tax that does that. So that's another piece that you haven't even commented on.
There's anybody from Tennessee here, they know that S corporations actually pay a tax where their personal income is not taxable in Tennessee. So there are situations where understanding what state you're in, it makes a big difference. But overall, especially from a federal perspective, I think the S corp wins 99% of the time. Let's talk about these limitations real quick. So if you're a professional, whether you, like a doctor, lawyer, accountant, professional athlete, these are the disciplines that are mentioned in the law. Your deduction phases out, and literally completely phases out by the time you hit 207,500 on taxable income single, 415 taxable income married. Whereas if you're not one of these specified service businesses and you start to hit this phase out, you're not on the road of phasing out, you're on the road of having to meet test guidelines. These test guidelines have to do with your W-2 wages and the capital that's inside the business. And the purpose of this slide is to say, trying to figure out who is specified service and who is not is going to be a big deal, because I can run a company that does $2 million net income, and if I have lots of wages or lots of capital, I'm going to get that deduction. Whereas if I'm a single attorney that makes $210,000 of taxable income, I get zero. You're completely out. So there's going to be lots of planning of how do I not get completely out. There's a couple more slides here, Hector, that I can try and get through here just real quick.
Hold on real quick.
Sure.
So completely out, it's a big problem, right? Because it's a portion of the tax code that you get absolutely nothing on. So my general suggestion to that is, if you're an attorney and some of the stuff you do is not attorney work and you do get income for it, let's say you're getting royalties for a book you're selling, or you're getting some sort of subscription service that's not really legal services, it's more, access to some sort of portal with legal documents, I would actually separate the businesses where the actual legal services are in one entity and everything else that's ancillary to that is separate. That way you lower the taxable income on the portion that could potentially be phased out. But be aware, because this is being recorded and this is going to YouTube. I'm not saying you're avoiding tax, evading tax. We're saying that you are having separate segments of your business that could be legally separated and therefore take advantage of the tax, because a lot of folks are going to be doing that.
Well, they're different businesses. There's a business reason for that too. So in doing all of this, I can't just say, well, I'm going to set up part of my accounting firm over here and part of my accounting firm over here. That looks like evasion. But what I can do is, if I have different operations, I have a business reason to try and separate them. I don't run my software companies through my accounting firm. So that's the kind of thing we're talking about here.
It's a perfect example.
On the 315 threshold, and this is the married threshold now, what happens is, if you are not in a specified service business, so everybody else that's not a professional, let's say, once you hit 315, you have additional tests that have to be met. So you either can take 50% of your payroll expense, or you can take 25%. Why is that 50%? This is supposed to be 25% here, plus 2.5% of your capital assets. So I apologize for that. That should be 25%, not 50%. But the idea here is the issue. And it is that if you're not paying payroll in your business, you don't get to pass the test. So let me ask you a question. If you own a sole proprietorship and you make more than $315,000, now sole proprietorship can't run payroll to its owner. It's just, it's not really allowed to. That's not something that where a sole proprietorship is allowed to do that. What the IRS is saying is there should not be any single owner sole proprietorships, which is kind of the definition of a sole proprietorship, over 315,000 if you make over 315,000 net income, because you can't apply these tests anymore. So there's, to some degree, a reason why you have to convert to S corporation once you start to make a lot of money, because that's the only way to have payroll so that you can meet the tests. So if I had someone who is $1 million sole proprietorship, I need to be moving them to an S corporation just so they can start running payroll and meet the 199A thresholds. Otherwise, they're out, because the payroll test will fail. It'll be zero, and that means your deduction is zero. So that's a problem. If we're taking a look at how to calculate this, here's a slide that kind of shows a little bit about how the calculation works. So if your business income is 175,000, the excess taxable income is something that everyone's going to get used to hearing in the business, because that is how we decide how much of the of the deduction is getting phased out because you're over this taxable income threshold. So in this case, with business income at 175 minus the standard deduction and everything, this example shows that someone was $5,500 over the 157.5. And so you end up doing all these calculations to figure out what the phase penalty amount is. These are all terminology inside the tax deduction or inside the tax bill, and you end up with a pass-through deduction after your penalty of 33,240. Now you tell me, tax folks, how would you have calculated 33,240 using business income of 175 and 20%? You can't. There's no way you come up with this deduction in your head. And that's probably my overriding point again. You've got to be utilizing tools and software. This is not going to be the kind of thing you can do in your head anymore. And it's a big deal. So to kind of finish up my slides, S Corp remains the best. Self-employment tax continues to be the tax to avoid even after tax reform. The 199 deduction is going to be super complicated. And as I said earlier, I believe S Corp should become viable and as little as $10,000 worth of net income because of some of these things and because self-employment tax is still there and still an issue. And that's the end of my slides, Hector.
Okay, no, that's perfect, Chris. Let me see. Somebody says, what about a doctor that owns the building, separating the rental income from the practice? Would that be a good idea?
Yes, so you're going to see a lot of that where because the rental income also qualifies for the QBI, so you can separate the rental income from the business. You can pay, now of course there's issues here where if you pay too much rent, it can look like an evasion strategy, trying to get your income down to some degree, but getting your rental income up is a good idea because as we know, the rental income is allowed and is something where you can apply QBI to try and get some of this benefit. So if you own your own building, it's probably a good idea, and I'm not giving legal advice here, but if you own a building, it's probably a good idea to own that building outside of the operating entity that the doctor works in. So you've got Doctor Inc., and then you've got Building LLC, and they're separate so that one is not necessarily of an asset of the other, subject to litigation, that kind of thing. But here, it's also very good from possibly a tax perspective in trying to plan out what's the best route to take advantage of some of this. So I would absolutely recommend some of that. Again, make sure you're using your software to run hypotheticals and figure out where the sweet spot is, because each of your clients is going to have a different sweet spot, and without being able to do it in your head, it becomes kind of a job to do. If you're a small business owner, make sure your practitioner is showing you some of these things, and make sure that you're having meetings now. It's no good to have a meeting with your tax guy
post-mortem.
Right?
Yeah, the post-mortem tax planning is, hey, last year I made 300,000. What can I do?
Who makes tax planning software, please do it early, because all the tax planning that is worth anything is done during the year, not the end of the year. For those of you who pay children, keep in mind, kids can now be paid $12,000, essentially tax-free. With exception to some of the maybe some payroll taxes if you're in an S corporation. But you used to be, because the standard deduction has gone up, we can now pay our kids a lot more, run it through the business. They don't have to pay tax on it because they use their standard deduction. Boom, boom, boom. There's lots of this kind of stuff out there where you can show people legitimate ways to save on tax rather than saying, well, don't run any payroll in your S corp.
Right.
I mean, there's legitimate ways to do it.
If you're the business owner and you have kids and your kids are shredding paper, whatever it is that kids do, you can pay them $12,000 a year from the business, get the deduction. It needs to go into their own bank account, and maybe, use that money to pay for a prepaid college. Use that money to put money in their 401k, put the money in the IRA. There are legitimate ways for a small business owner to move the money to another entity or to a retirement plan or something like that and get huge tax savings for it. But you can't do a lot of these things post-mortem. You can't do these things in March. You can't do these things in April. Plus, if you're a tax preparer, I think your clients would pay you to visit you all year long. If at the end of the day you're going to save them $3,000, $4,000, $5,000 in taxes, you could justify charging $2,000, $3,000 because you're getting a piece of that. You never charge as a percentage of what you save, but you can certainly justify your fees by giving your client a tax saving.
There's
So
so
Chris,
much to plan here. There's so much to do. I can't tell you, I've never been as excited about sending out direct mail. Now, you may find this very old school. We send out a lot of direct mail at
yeah,
our accounting firm, a ton
yeah,
of it. And
yeah,
our direct mail letters right now are talking about, do you know what the 199A deduction is? Do you know what you should be set up as from a corporate structure perspective? Do you understand you could lose out on all of this if you don't plan this correctly?
right. Or the best thing to write in the letter is, has your current accountant proactively called you to set up a tax plan that will take advantage of the tax laws?
Oh, believe
And I
me,
bet
it has that kind of wording, right? It's like, surely you've heard from your accountant by now about the 199A deduction, all of that. And if you're sitting there saying, well, I haven't talked to my clients about it yet, that's what we're trying to say. Get
right,
out in
correct. If
front
you
of
don't
this.
talk to them, if you don't talk to them, Chris and I will send them a mailer and steal your clients.
Yeah, don't think that we're not already sending mailers out to everybody, because we are, but you have them. It's tax season right now. This is why we want to do a timely webinar now, is
Right.
because you can get in there and say, hey, here's where I'm providing you some value. Let's get a planning engagement together, because you need to know this. This is thousands of dollars. Give me a little taste of it, and we'll make sure you get everything that you're due.
Absolutely. So thank you so much, Chris. I appreciate you coming in today. And how can people get a hold of you? What's the best way of people getting a hold of you?
Well, if you're an accountant, you'll want to go to gethalon.com and sign up for our accountant program, where we go through quite a bit of this tax planning and tax lessons and how you can do some of get involved with Halon and get involved with Tax Planner Pro. And I, of course, tweet at C Reagan TPP, at C Reagan TPP. But if I could leave my piece with one thing before you clean up some of the housekeeping, dive into this. Take a little bit to dive into this now. Like when you get off this webinar, go through this a little bit, because tax season's about to get really busy, and you are not going to have time to dive back into this maybe until April or May. And there's some conversations you need to have with 5 or 10 of your clients. You know who they are. Some conversations where this is really a big deal. So make a plan now. Get that value and make sure you bill for it. That's all
Absolutely.
I got.
Absolutely. So I'm going to run the last polling question, then I'll tell you real quick about the other webinars we have coming up. Okay, so it's data import into QuickBooks Masterclass. I'll talk to you about taking bank statements from PDF, from Excel, from CSV, and cleaning them up and bringing them into QuickBooks to avoid manual data entry. I officially started the war against data entry. That's my new motto for this year. If any of you are doing data entry to prepare tax returns, because you're doing financial statements in QuickBooks by hand keying stuff, you have to attend this webinar. I want to show you what tools are out there, how to import what QuickBooks has available, what third-party tools are out there, and how to use them. And there's a coupon code, this EPIC25 for 25% discount. I'm just being funny by calling it an EPIC webinar, just because I never taught all this content in one place. I have like this plethora of YouTube videos, which are very popular, by the way, with different things, batch enter, transaction pro importer, money thumb, scan writer. I have all these different, sort of videos scattered across YouTube. But this one webinar, we'll put it all together, and it will cover QuickBooks Online and QuickBooks Desktop. So I am plugging that and plugging that hard, because I'm only doing this webinar once, and the recording will be available only to the folks that register. So there's the link for that. And tomorrow we'll have QB Power Hour, which are free webinars, and we'll talk about managing sales tax in QuickBooks Desktop, and that's qbpowerhour.com. So with that being said, stay connected. Email me if you have any questions. Join the Facebook group. Chris is active in the Facebook group. He has his own Facebook group called Halon Tax, I believe, or Tax Planner Pro, or maybe 2 Facebook groups. Facebook, believe it or not, is actually the best way to get a hold of us, because instead of doing actual work, we're sitting all day long playing with Facebook, which is not a good thing.
We're answering a lot of questions. That's if you've never been in any of these Facebook questions or Facebook groups, Hector and I are answering a ton of questions. I'm in his groups all the time. He's in my groups all the time. And between the two of us and several other people who are in there with us, you will get an answer to what you're looking for. And it's free. So it's a very helpful kind of situation. Facebook is kind of changing the landscape in that way as far as groups go, I think.
Yeah, and I'll add say one thing real quick since we're talking about it. Everybody tells you need to be on Facebook because that's where you need to do your marketing. And if being on Facebook to you means, setting up an account and setting up a business page and just sitting there waiting for business, that's not what being on Facebook is. Being on Facebook is going where your clients are. What are they talking about? What are their concerns? What are their worries? Go where your colleagues are. What are they telling you their concerns and the issues are? You're going to learn massive amounts of market intelligence from what your colleagues are doing and not doing and what your clients are asking for. And if you're out there, and it does take some time, answering questions and providing value up front, people eventually go, wow, my regular accountant, I have to make an appointment to see them in 2 weeks and pay him $300 to ask him questions for 2 hours. I got this guy that within 10 minutes answers my question on Facebook. Who do I want to hire? So the Facebook strategy is not playing around in Facebook. It's being out there proactively looking for ways to add value. And that's Chris and I think we've mastered that game. I've built tons of relationships by helping people on Facebook. Chris has built tons of relationships by helping bookkeepers and accountants learn the
entire
tax
software companies have been built through these Facebook groups.
Absolutely.
And so it's a very powerful place. If you're not involved, start at Tax Power Hour, and you will eventually see where the rest of them are too. So
yeah. So I have to have lunch because I have a webinar in 40 minutes. So Chris, thank you very much. Thank you, everybody. Have a wonderful day, and I hope to see you on the webinar in a couple hours or in the next Tax Power Hour or in the next QB Power Hour or in Facebook or in my email or whatever. Thank you very much.
Bye.